and welcome to the Tax Roundup for February, and Happy New Year. First up, we're going to explore a topic very near and dear to most practitioners' hearts, which is profits inside professional services firms, and a new review from the ATO. Then we'll move across to an exposure draft from Treasury, which seeks to implement the super guarantee integrity measures that were announced in the budget. And then we're going to take a look at a case which is causing a bit of a stir at the moment, dealing with the effectiveness of trust distribution resolutions, and that's one not to be missed. But first up, we're going to go across to Mike, who's looking at a new PCG that potentially provides a safe harbour dealing with exempt car fringe benefits. Across to you, Mike.
Now, the ATO has released some draft practical guidelines dealing with the special rules that apply within the FBT system to exempt motor vehicles. Now, normally when an employer provides an employee with the use of a motor vehicle or a car, that can trigger an FBT liability, either as a car fringe benefit or as a residual fringe benefit. However, there are some situations where those types of benefits can be completely exempt from FBT. Now, there's basically two broad things we need to look at there. First of all, we need to check what type of vehicle has been provided. Things like commercial vehicles, utes, panel vans, etc., these can potentially qualify for the exemption. Once we've determined that the vehicle itself could qualify for the exemption, we then have to look at the way it's been used by the employee. And basically what the rules say is that if you have one of these eligible vehicles and private use of that vehicle by the employee is quite limited to trips between home and work, to trips that are incidental to performing their employment duties, or very limited minor and other private use, then that benefit can be exempt from FBT. Now, the question mark that's been around for many years is when we come to looking at that other private usage of the vehicle, how minor does minor have to be? What is the threshold there? Now, the ATO is not necessarily telling us a black and white answer to what that is, but they are giving us some practical guidelines and saying that if you fall within the scope of this guideline, then the ATO won't basically take active steps to review compliance with the exemption. Now, this practical guideline won't apply to everyone. There are some pretty strict conditions, at least in the draft version, that would need to be met to be able to rely on this. For example, the guideline will not apply if that vehicle has been provided to the employee under some sort of salary packaging or salary sacrifice arrangement. If that's the case, you can't use the guideline. Doesn't mean the exemption isn't available, but you would need to look into it in a little bit more detail. Also, the guideline won't apply to luxury motor vehicles either. Now, the other thing that's interesting about this guideline is it says, well, the ATO won't devote compliance resources to look at the exempt use of the vehicle, but where we're looking at minor usage, the ATO is pretty strict on what that is. The ATO says that other minor usage can't be more than 750 kilometres in total across the FBT year, and no single return trip can be more than 200 kilometres in distance. One of the other things is that that vehicle needs to have been provided to the employee for use in their employment. And lots of people these days would have vehicles that have been provided to them as a fringe benefit by their employer, where that vehicle doesn't really have any direct connection with their employment duties themselves. So there's a whole range of people who won't qualify for these guidelines. There will be some people who do and can potentially reduce some of the risk and compliance costs around managing that area. But it is worth taking a look at if you do have clients who have been in this area of exempt motor vehicles and just looking for a way to try and minimise some of the risk and exposure when it comes to those rules.
Now I'd like to welcome Natalie, who is Knowledge Up's new superannuation consultant, and this is the first time she's been on camera, telling you about the new exposure draft from Treasury on the super guarantee measures.
A new exposure draft released by Treasury seeks to implement the super guarantee integrity measures announced in the budget. Included among the changes are the potential for criminal penalties to be laid against employers who fail their obligations. Underpayment or non-payment of superannuation guarantee is a big issue. The ATO's own risk assessment suggests that between 11% and 20% of employers could be non-compliant with their SG obligations, and that non-compliance is endemic. The measures take a tougher stance against employers who fail their commitments and bolster reporting requirements. Firstly, the ATO will be able to issue directions to pay unpaid SG and undertake SG education courses. That is, employers will need to take a course and prove they understand their commitments. For those employers that fail to comply with the direction, the ATO will have the capacity to pursue criminal penalties. This would include fines and up to 12 months in prison. Secondly, single touch payroll, which is compulsory from the 1st of July 2018 for employers with 20 or more employees, will be extended to include all employers regardless of size by the 1st of July 2019. So an employer with a part-timer would face the same reporting requirements as a larger company. Finally, the ATO will be able to tell current and former employees about the failure or suspected failure of an employer to comply with the SG obligations. They can also keep them up to date on the action taken and the recovery process. We'll keep you up to date with the progress of this bill.
Now, Michael is going to take you through that review by the ATO into the allocation of profits inside professional services firms.
Back in the 2015 year, the ATO released some guidelines around the possible application of the general anti-avoidance rules in Part 4A to the way that professional services firms split their profits with practitioners and their related parties. Now, at the time, the ATO basically said that if you've got a professional services firm that is earning income from its business structure, not from the personal services of any particular individual, then while there is some scope to split profits from the practice with people who aren't necessarily the practitioners themselves, the ATO placed some practical limits around that. Basically what the ATO said was, they said, look, we're going to give you 3 safe harbour guidelines. If you can meet any of these 3 guidelines, then we'll treat you as low risk when it comes to dealing with Part 4A and the way you've split the profits of that practice. However, if you fail all 3 of those safe harbour guidelines, you'll be classified as high risk. Higher risk of being reviewed, higher risk of some tax adjustments being made. Now, when the ATO released those guidelines back in 2015, they said a couple of things. First of all, they said they'd try and find a test case to flesh some of this out through the courts. That hasn't happened yet. Well, the ATO also said that they would be reviewing those guidelines during the 2017 year. Now, it appears the ATO has done that because quite recently the ATO has said that they are suspending those guidelines from here on. Now, the ATO is concerned that people are relying on these guidelines and using them in ways that they didn't envisage when they put them together. For example, arrangements involving related party financing and arrangements involving self-managed super funds. The ATO says, well, they never expected that these guidelines would be used in connection with those types of arrangements. As a result, the ATO is suspending those guidelines completely. The ATO has said that they will engage with stakeholders, practitioners to come up with some revised guidelines, as well as possibly putting in place some transitional provisions to deal with the break in time from when they've suspended the older guidelines to when finally we get some newer guidelines. Now, it leaves us in limbo a little bit for the moment. I guess from a point of view of previous years, the ATO said they won't generally seek to disturb that. They'll allow those guidelines to still be relied upon by people for previous years. Where we go to for the current year onwards, we're just going to have to wait and see. Certainly, if you're thinking about restructuring or reorganising arrangements at the moment, might pay to be a little bit careful around how you do that. Maybe even hold off on making any final decisions for a bit to see what the ATO comes up with. In the meantime, it is worth being aware that those guidelines that you may well, for your own practices or for some of your clients, whether that's medical practitioners, engineers, lawyers, whoever it might be, those guidelines that the ATO had have been suspended. They're now off the table basically, and we're just going to have to wait and see what the ATO comes up with next.
In cases this month, Michael is going to take you through Lusky versus the Commissioner of Taxation. Across to you, Mike.
There's an interesting case that went through the federal court towards the end of 2017, and the ATO has issued a decision impact statement on that quite recently as well. And this is the Lusky case. It deals with trust distributions to a beneficiary and whether they are actually effective in creating present entitlement for the purpose of applying the tax rules. Now, the facts are a bit convoluted and complex in this case, but basically what happened was there was 2 trusts, related trusts. And in 2006 and 2007 income years, those trusts had claimed some deductions, and I think from memory, around tax losses that had been generated in previous years. Now, those deductions obviously reduced the taxable income of the trust, the net income of the trust for tax purposes, which then had a flow-on impact to the beneficiaries of the trust. It meant they paid a little bit less tax than they would otherwise have. Now, what happened then was that the Commissioner came along and disallowed some of those deductions in the trusts. That increased the taxable income, the net income for tax purposes of those trusts. And what happens in that case is you've got to figure out, well, who pays the extra tax? Now, if all of the income of the trust has been appointed to beneficiaries and they are presently entitled to the income for that year, then the extra tax normally just gets taxed in their hands. So if you were presently entitled to 50% of the trust income, then you will pay tax on 50% of the taxable income of the trust, regardless of what that taxable income is. And that's basically what the Commissioner sought to do. The Commissioner assessed or issued amended assessments to one of the beneficiaries of the trust, said that, well, you're presently entitled to a certain share of the income of the trust for those years, therefore you're now being taxed on a slightly higher amount, given that the taxable income of the trust overall has increased for those years. Now, the taxpayer objected basically to the ATO's decision and said, well, actually, I don't think I'm presently entitled to any income of the trust at all. So what we ended up with was the court having to decide, was this beneficiary actually presently entitled to the trust and therefore taxed on some taxable income of the trust. Now, the trick to all of this was that when the trustees decided on the resolutions to distribute income for those income years, they made two resolutions. The first resolution was basically the distribution resolution. It said that this beneficiary is presently entitled to X dollars or X percent of the income of the trust for the year. But the trustees also made a second resolution at the same time. The second resolution said that if the Commissioner comes along and increases the income of the trust or denies some deductions of the trust that impacts on the taxable income of the trust, then those previous distributions basically aren't effective anymore. Now, the Commissioner said that those two resolutions happened sequentially. You had the first one and then the second one happening at some point afterwards. And the Commissioner said, well, all of the income of the trust was dealt with under the first resolution. It's a valid resolution to appoint income to a beneficiary. Therefore, what happened in that second resolution, basically you just ignore it. That income has already been dealt with. So you don't even look at that second variation resolution. Now, the court disagreed with the Commissioner. The court said in this case those resolutions happened at the same time and they should be read together. As a result of that, the court actually found that this beneficiary was not presently entitled to income of the trust for tax purposes. That didn't necessarily mean they couldn't receive some income from the trust from a trust law point of view. That's a separate issue. But they were not treated as being presently entitled to the income of the trust from a tax point of view. That meant they couldn't be taxed on any of the taxable income of the trust at all. Now, as the ATO notes in its decision impact statement, the unfortunate thing is the court didn't say who should pay the tax. They just said that this particular person wasn't to be assessed. Now, the ATO's view is that, well, in a case like that, probably the default position is that the trustee of the trust should be taxed. And not only taxed, but taxed at penalty rates. Now, the ATO has indicated that in situations like this in future, as they come across them, that is probably what they'll seek to do. And they may well make multiple assessments so that if the assessment on the beneficiary happens to fail, then they'll have a fallback assessment at the trustee level. Now, I've certainly heard some commentary of people saying, well, we need to revisit the way that trust resolutions are put together. Maybe we should be thinking about doing something like this. But do remember that even though in this case the beneficiary got out of paying the tax, it didn't mean that no one has to pay the tax. There is still a tax liability that needs to be assessed, in this case probably to the trustee. Now again, there's a question around amendment time limits. It's a little bit funny when it comes to trustee assessments. The ATO has some, practical guidelines around that, but the law on it is a little bit fuzzy. So again, there are some really practical things that are important to take into account before you jump in and use something like what happened in this case. So certainly an interesting case when it comes to trusts' present entitlement to income. What does it mean? We may see some further developments from this as time goes on, but certainly an interesting case as we kind of think ahead to the end of the current year when trustees are going to sit down and start making these resolutions.
And that's the tax roundup for this month. It is going to be a year of constant change yet again. If you want to stay on top of things and you're not a Knowledge Shop member already, then give Julie a call on 1800 800 232 and she'll be very happy to show you everything that the membership offers. We'll look forward to speaking to you soon. See you next month.